Hello and assalamu alaikum everyone. So now we are towards the end of the chapter. We have talked about published accounts, we've talked about the contents of published accounts, your statement of financial position, your income statement, then we have talked about ratios which we calculate using those particular documents and how what are the types of ratios, how do we use those ratios, and what are the limitations of those ratios, how we can increase those ratios, etc. So finally, we'll talk about the use of published accounts to specific stakeholders, and then we'll wrap up this chapter by talking about the limitations of published accounts when they are being used by the stakeholders. So, and also we need to have a little discussion on financial versus non-financial indicators of performance. So, stakeholders can themselves be divided into internal and external stakeholders. If you recall from chapter 1, unit 1 chapter 5, we talked about that is when we talked about stakeholders. And in business studies there are a lot of questions regarding stakeholders. Okay, so what will happen, what is the effect of so and so decision on stakeholders. So one of those questions is the usefulness of published accounts to stakeholders. So let's talk about that. Now first we talk about internal stakeholders, and then we talk about external stakeholders, since it is of more importance to internal stakeholders than it is of then as compared to external stakeholders. So first of all, we have managers. Of course, managers will use this information. So how will managers use that? So I've had a long data over here to signify the importance of the published accounts to managers. So first of all, the financial data provided in published accounts can be used to make sure multiple departments are on the same page, so they can have a shared understanding of the organization's current financial health and offer perspective into other managers' goals and motivations. Overall, it helps in controlling and monitoring the operation of each department and division of the business. So basically, it's all about the departmental coordination. Okay, it is very vital to understand what is the information provided in published accounts, and make sure all the departments are coordinated on the same page and have the same understanding of that information, and see, okay, what has happened before, what are the profits before, what are the liquidity before, and what should be done now. So it helps them to be coordinated and look forward, look what has happened, what will happen, and help each other. Different departments will have different managers, so all of those managers cooperate with each other, help each other in their goals and motivate them, and overall helps them controlling and monitoring the operation of each department and division of the business. Also, it can be used to manage and plan budgets and review these against actual performance. So you know you look at your previous performance. Okay, how much was the budget you used up in previous year, what is it now, what is your planned budget. Okay, what is your investment paying off or not. Okay, so you can just compare your planned performance, your benchmark goal of profits and sales with your actual performance, if you have achieved that or not, reviewing your actual performance basically. So, and seeing a list of every expense and how it impacts your company's net income can be an eye-opening chance to save money and reallocate spend where it's needed most. So basically, if you have all of this information, you can see each expense and how it has impacted your net income. Okay, how some of it has impacted you, some of it in the form of variable cost have decreased your gross profit, and some of it in the form of overheads have decreased your operating profit overall. So how, where is it that the cost, to you look at each cost and see which cost is was worth the profit or not. Okay, so profitability ratios can be used to review the expenses incurred, and if it can be reduced, and hence move forward by doubling down on investments that paid off. So you want to reduce your costs, your expenses, and invest double on those investments that you know that paid off. Okay, so for example, if you know that you bought a particular new brand of machinery to help in your production, and you see that, okay, that has boosted your productivity a lot, so you will continue to have to employ more of such new machineries, that particular brand. So basically, to see if certain expenses and investments were profitable enough or not. Okay, so those who were profitable, you will want to invest more in that, and those who are not, you will just want to withdraw your investments from that. Managers can use the statement of financial position to calculate liquidity ratios and hence judge whether or not the business will face liquidity problems in the near future. Okay, just a spelling typo over here. Let me correct that. I apologize for the small typos. So, of course, if you have your statement of financial position in the published accounts, you can see your liquidity ratios, and see if the business will face liquidity problems in the near future or not. What is its current position? What is its current ratio? What is its quick ratio? Is it relying too much on its inventories for your is it okay to rely too much on inventories or not, depending on the type of the business? Is it retailer or manufacturing business? Okay, so overall it helps them to take important decisions, such as whether to continue or discontinue certain operations, to make new investments, or to go forward with expansion if the business has enough retained earnings. So the main purpose of managers is to review this information, save your costs, and finally, with all the profit and liquidity that they have, look using that data, they see if they should continue with the current operations that they were planning to do, to expand or not, to make new investments, to purchase new inventories, etc., purchase new equipment, to employ more labor, or train the existing labor force, or layer the organization to have more to have more management, and motivate some employees, particularly those who are made managers position, and or perhaps delayer the organization to lay off some costs. And so all sort of decisions can be made. Then we have shareholders. They will be interested in sales revenue and operating profit before taxation, as it provides guidance on performance when compared to previous years. Therefore, helps them to assess the value of the business and their investment in it. Also, it helps determine if the business is becoming more or less profitable. So, of course, the main concern of shareholders is the profitability of the business. What was the previous profitability? How is it now? Has their profitability been growing or deteriorating over past years? So, of course, they will look at all this information to see if they should continue investing or not. Potential investors would also, when I say shareholders, that means existing ones and potential investors. So they will also see if they should invest in this particular business or go to some other competitors, etc. Published accounts can also be used to determine the going concern of the organization, that is, to make sure if it has sufficient capital to continue its operations indefinitely and hence able to avoid bankruptcy. So of course the going concern is an A2 term perhaps, so you might not be familiar with it, but it basically checks if the business has, if what is the current operation position of the business. Is it able to continue its operation, or is it becoming bankrupt, or the jobs are being at a risk or something, the business itself is at a risk of closing down. So that of course shareholder will want to look at by looking at the liquidity position and the profitability position of the business. Shareholders will also look at how profits have been distributed between retained earnings and dividends. So of course they want to see how much of the profit was given to retained earnings and how much was it given to dividends. So of course different shareholders will have different views of that. If they have a short-term profit aim, they will want greater dividends. Otherwise, if instead they have a long-term aim, they may welcome substantial reinvestment in the expectations of future profits. So it all depends on the stakeholder, the mindset of that stakeholder. Is it a short-term stakeholder or is it a long-term shareholder? Overall, it helps them consider the work of the investment and see if they should sell their existing shares or purchase more shares. So of course that is the main purpose of checking the published accounts, to see if they should invest more in the business or withdraw their investment, sell off their shares, and go off to some other competitor business. Moving on, we have employees. Employees, of course, they want to know that they are concerned with the job security of the business. So they want to know the stability and profitability of the business, particularly if their pay is based on profit related pay. So they want to know the stability, profitability, and of course profit related pay. We have talked about that in the marketing chapter, and when talking about the 4 P's: price, no, sorry, not over there. We've talked about this profit related pay in our motivation chapter, where we talked about HRM and all, and that unit 2, human resource management, where there we talked about methods of motivating employees. So financial methods was profit related pay, where you pay your employees a certain amount of your annual profit, okay, as a reward for their efforts. So if the business has been making a good profit, then of course the employees would want a good pay in the form of profit related pay. The profit after taxation will indicate the ability of business to fund an increase in pay, or alternatively to assess whether the business is secure enough to pay wages and salaries. So they of course the employees will be concerned with the job security. So depending on the business they are in, they will probably want to see if the business is secure enough to pay wages and salaries, that is, if it has enough liquidity and profitability and future long-term profitability. And they will also see if they are making quite a good profitability, then if they are able to, if they can ask the business to increase their wages and salaries, okay. So to ensure the fairness of the salaries they obtain from the organization according to their earnings, so they will of course want to see if their wages and salaries are worth it or not, or perhaps they are being underpaid, okay. Then we have external stakeholders like suppliers, government, customers, and local community banks. Let's just have a quick go through of them. Suppliers, of course, they want to see if the business is secure and liquid enough to pay off its debts, because of course the debts that it has on the suppliers. So generally you purchase your suppliers on credit, okay. You say I'll pay for the suppliers 1 month later, or depending on your contract. So the suppliers would want to see if the business has enough liquidity to pay off its debts in the near future as well. In the statement of financial position, if the statement of financial position records a healthy working capital position, suppliers may be more willing to grant trade credit to the business in question. So if they see okay, the business has quite a good working capital, okay, they have quite large number of current assets as compared to current liabilities, then okay, they can give them more credit period for paying off their debts. Alternatively, they can use this information to press for early repayment of outstanding debts if the business is in a liquidity crisis, or if its profits have been deteriorating over time. So if instead they see, oh, the business is not doing too well, its liquidity is so drowning, its working capital is negative, and its profitability has also been deteriorating, so we should just ask for early repayment of our outstanding debts, and then just discontinue operating with this business, okay. They will just want to go to other businesses. That's for suppliers. Then we have the government. The government is of course concerned with the taxes and the employment opportunities. So they want to will want to use that particular information provided in the published account to collect accurate taxes and amounts from organizations on due dates. They will also want to ensure the organization's compliance with government rules and regulations, and check if the published accounts meet all necessary standards, that is, if all the accounting regulations are being followed. And finally, they'll also check the going concern of the company, that is, if the business has capacity to grow and expand with increased profitability, and hence provide more employment opportunities, or alternatively, if the business is having liquidity problems in addition to decreasing profitability, which may be alarming as jobs may be lost. So that's for government. So they are concerned with the employment opportunities. They will see if the business is profitable enough to pay off its employees, or perhaps it's having liquidity problems and profitability problems, because of which it would probably lay off some employees. So what should be done in that particular case? Perhaps try to help the business and secure those jobs. Customers would want to ensure the stability of the organization, so that they can determine whether they will be assured of future supplies of the goods they are purchasing. So they want to see if the goods that they are purchasing, it will be supplied in the future or not. And perhaps it's not a necessity, but perhaps customers would also want to have knowledge about the cost structure of the products that the organization is producing, see how much value the business has added, and if it's worth the price or not. And finally, we have local community and banks. Let's go over them quickly. Local community will be concerned about the organization's substantial contribution towards the community society. They want the organization to contribute towards society if it's making profitable. So they will want to see the profitability of the business, to see if the business is profitable and likely to expand, which will be beneficial for the local economy as more employment opportunities will be created. And we have banks. They will of course, similar to suppliers, they want to see if the liquidity and the profitability of the business, to decide whether to lend money to the business or not, and to assess whether to allow an increase in overdraft facility or discontinue it. So that's all for today, and the next lecture we'll talk about the limitations of published accounts. Thanks for watching, and Allah Hafiz.